Hey, this is Yus, your Runners-Point investment firm that specializes in REIT investing, and in today's video I'm going to discuss REITs that I would avoid going into 2025. If you're new to REIT investing, it's important for you to know that the REIT market is vast and versatile with over 1,000 REITs worldwide, and not all of them are worth buying. They invest in 30 plus countries, 20 plus different property sectors, and some of them are facing significant headwinds, all while others are enjoying rapidly growing rents. Moreover, there are also vast differences in valuations from one property sector to the next. Today I'm going to highlight 4 different types of real estate investment trusts that I would avoid in 2025. The first one may seem obvious, and those are office REITs, but right now there are increasingly many value REITs that claim that office REITs are offering a great investment opportunity. They are still trading at significant discount to their pre-COVID levels, even as more and more companies are requesting their employees to get back to the office. Amazon is one of them, Tesla is another. I think that Trump just recently signed an executive order asking federal employees to get back to the office as well. And this is causing a lot of investors to think that office REITs are about to bounce back. Even then, quite a few of them are still heavily discounted. Taking the example of Boston Properties, ticker symbol BXP, which is one of the largest office REITs, it still trades at a 50% discount to its 2020 levels, and that's despite all the inflation that we've experienced in recent years, which has increased the replacement value of its properties. So that's the bull thesis in a nutshell, but I think that there are significant flaws to it. And the main flaw is that yes, while most companies are returning to the office, they are not all returning full times 5 days a week to the office. Typically, they are returning 3 to 4 days in the office with 1 to 3 days still working from home, and this is reducing the demand for office space. As a result of this, vacancy rates have now shot up to over 20%, which is the highest level ever recorded for offices, and it's expected as more long-term leases expire in the coming years, we'll see vacancy rates rise up to 25%. What this means is that a lot of office buildings are today sitting vacant, with landlords desperate to refill them, willing to offer significant tenant improvement packages and to cut rent levels just to secure a tenant. Some investors seem to think that this is just a problem for Class B and Class C properties, and while it is true that these property types are more heavily impacted than Class A, what I fear is that a lot of these vacant buildings will change hands over the coming years, and as new owners come in, they will have a much lower basis. They will heavily reinvest in these Class B and C properties to make them more competitive with Class A assets, and so this will lead to increased competition and put more pressure on rents, even on the best assets. Another problem is that the needs of office tenants have changed in recent years as a result of the fact that their employees are working even just 1 day a week at home. This changes their needs for the type of office space that they need, not just the quantity, but also the quality and really the type. You need different types of amenities. As an example, you don't need as many desks in the office space, and so this will likely force the office landlords to heavily reinvest in their properties, increasing the need for capex. And if the landlord refuses to do so, the tenant will simply move to another property because there are so many sitting empty anyways. And so yes, a lot of office REITs are trading at relatively low FFO multiples, at discount to even conservatively estimated net asset values. But if you look at the prospects for growth in the coming years, adjusted for capex, I think that they are very limited. And taking that into account, they really aren't that cheap relative to other property sectors. For this reason, I have no interest in office REITs at this time. Hey, before I go into the second property sector, can you please do me a huge favor and click the like button and subscribe to the channel? That will help me a lot to keep on growing. Thank you so much. Okay, so the second category of REITs that I would avoid are retail REITs. And I want to clarify here that I own quite a few of them, so I don't mean to say that you should immediately sell all your retail REITs. In fact, they are performing really well. They're enjoying strong fundamentals because there's a relative lack of new supply. This is leading to rapidly growing rents following the past few years of high inflation. But the problem is that this is now mostly priced into their valuations. They've enjoyed an impressive rally over the past year, and as a result, they now trade at historically expensive valuations. To give you an example, the outlet center REIT Tanger, ticker symbol SKT, currently trades at about 17 times FFO, but outlet centers are not exactly a growth sector. On the contrary, I fear that they will suffer over the long run from the continued growth of Amazon and discount retailers like TJ Maxx. Outlet centers used to stand out by promising the best prices, and consumers were willing to drive even longer distances to get to the closest outlet once in a while. But simply competing on price is not enough anymore in the day and age of same-day shipping, and there are a lot of other discount retailers, typically in more convenient locations at open-air shopping centers, and so I wouldn't pay such a high multiple for this type of properties. And unfortunately, Tango is not an exception. Most retail REITs have now repriced at higher levels in the 15 to 20 time FFO range. I think that there are better opportunities in other property sectors. The third category of REITs that I would avoid are data center REITs. And those are really popular right now because the boom in AI is leading to rapidly growing demand for data center REITs. But unfortunately, once again, these strong fundamentals are more than reflected in their current valuations. A good example here is Iron Mountain, ticker symbol IRM. This is a REIT that we used to own at one point at High Yield Landlord. I still remember that we're buying it at the high single-digit multiple of its FFO. Its dividend yield was around 8% at one point, and we thought it was a great value opportunity. But since then, its share price has surged as if it was the Nvidia of the REIT sector, and now it's trading at over 30 times FFO. I think a very low dividend yield of 2 to 3%. And this just doesn't make sense in our opinion based on its long-term growth outlook. Yes, it's growing really fast right now, but we don't think that this rapid growth will last for very long because, when fundamentals are very strong in real estate, this attracts a lot of property developers. They start building new properties. Eventually, the supply catches up to the demand and you even get oversupply typically. And I fear that when that happens for data center REITs, we'll see the valuations come down very significantly. And so the risk reward is relatively poor here with so much growth already priced into their stocks. Before I go into the next category of REITs to avoid, here's a quick word from our sponsor, High Yield Landlord. Over the past year, I've had the privilege of interviewing the management teams of some of the most prominent REITs, including Realty Income, Vici Properties, Stag Industrial, and many more. These exclusive interviews have helped me and the 2,000 members of High Yield Landlord build a portfolio of what we believe to be the best REIT investment opportunities, and today I'm excited to give you access to it completely for free. Simply click on the screen and you'll be redirected to High Yield Landlord, which is my REIT newsletter. Sign up for the free trial and you'll instantly unlock access to my personal REIT portfolio, all my top picks for the coming year, and much more, all free for 14 days. You can cancel anytime, no questions asked, but if you decide to stick with us after the trial, you'll also secure a special discount for joining today. We are proud to be the largest online community of REIT investors with over 2,000 members actively growing their portfolios with REITs, and I want you to be part of it. With REITs trading at historically low valuations at the moment, there has rarely been a better time to invest in this sector, and we think that 2025 could be a particularly rewarding year. Join us today completely risk-free and see why our members have rated us 4.9 out of 5 from over 500 reviews. I can't wait to welcome you inside. Okay, back to the video. The fourth category of REITs to avoid are mortgage REITs. And I avoid mortgage REITs during most times, but especially right now because the environment is just too uncertain. Let's face it, most of us don't know what's going to happen next. Is inflation going to accelerate or not? Are interest rates going to drop lower? Are they going to rise back up? Really, the near term is highly uncertain. Nobody really knows. But unfortunately for mortgage REITs, their fundamentals are highly dependent on these macro factors that are unpredictable. And therefore, investing in mortgage REITs, especially right now, feels like more like speculating rather than investing, and I have no interest in that. I would add that over the long run, mortgage REITs have performed really poorly relative to most other REITs, and again, this is simply because their business models are too dependent on macro factors that are unpredictable, and clearly the executives of these REITs have failed to predict the significant turns in macro factors, and this is why they've performed so poorly over the long run. I would much rather invest in other property sectors that are less dependent on macro factors and yet are heavily discounted today, like apartment REITs, industrial REITs, even a few farmland REITs. These are property sectors that have strong long-term secular tailwinds on their sides, medical office building REITs, and yet they are heavily discounted because of temporary headwinds and the currently high level of interest rates. But we think that as rent growth accelerates in the coming years and the Fed resumes its cuts to interest rates, we'll see these REITs enjoy significant upside. And while we wait, we are earning significant cash flow, with a portion of it paid in dividends to us and another portion being reinvested by the REIT to create more value for shareholders. Okay, so to recap, I would avoid office REITs, retail REITs, data center REITs, and mortgage REITs. I think that office and mortgage REITs are not particularly controversial opinions, but Avoiding retail and data centers are rather controversial at the moment because these are some of the most popular property sectors, but we just think that there are better opportunities in these other property sectors like apartment REITs and industrial REITs at today's valuations. If you want to access my full REIT portfolio, this is my real money REIT portfolio, you can join us for a 2-week free trial at High Yield Landlord. It will be the first link in the description of this video. You can cancel anytime, no questions asked. You won't be charged anything in the first 14 days. So just come in, see our research, see if there is enough value for you to stick with our investment strategy. If there isn't, you'll still gain value by just seeing my portfolio, see what I'm buying, reading some of our research, and then cancel. You won't be charged anything. Once again, thank you very much for your interest. If you could subscribe to your channel, that will help me a lot. Thank you and see you at my next one. Bye-bye.